Assalamualaikum and a good afternoon to everyone. A special thank you to Bank Negara, BNP Paribas and INCEIF for inviting me to the event. And also a special thank you to Professor Dr. Muhammad Shamsi for the invitation as well. Today, normally I will ask for the session after lunch hour because it'll be easier to speak after lunch. Unfortunately, I didn't get the chance this time around. But then again, I'll take my chance now, given that we only have about 30 to 40 minutes before lunch break. So I'll be counting on my blessings. Right. Today I'm going to touch base and highlight some of the risks when it comes to managing risks in the Sukuk industry. What I mean by Sukuk industry here is the Sukuk capital markets. I will run through some of who are the main protagonists in the industry and the relationships between these players. Secondly, I'll run through some of the major risks involved into investing into Sukuk and how it affects the Sukuk markets and in the current local market context and also in the global market situations. You'll find that I'm a very visual person. I will post up a lot more slides, and with that I'll speak less, I suppose. Fourthly, I'll run through some of the challenges that we're seeing in the market space and also the outlook going forward. Just to introduce a little bit about myself, where I'm currently attached with the syndicate desk in RHB Bank, even though it's called RHB Bank, but then where I am right now, we are involved on a group basis. We look after all the new issuance, primary issuance for Sukuk, conventional bonds, for either RHB Bank, RHB Investment Banks, and also RHB Islamic Banks. Right. In terms of players, I mean, you will be able to dissect into two segments for these markets. I mean, on the left side is the issuers, and on the right side is the investors. The issuer side, I mean, I'll see this is the sell side, mostly where they tend to tap the capital market for their funding needs, whereas on the buy side, which is the investors, these are the mostly institutions that are yield hunters. They tend to be buying for all these, investing their excess funds for investment purposes. My role is basically to interface between these two segments of clients and players in the market, where I interface with the issuers and trying to come up with the optimal solutions and pricing for issuers as they tap the capital markets. This is pretty much what investment banking is all about. We are here to match the users of funds and also the investors of funds. In terms of risk, where I'm sitting right now is pretty much I would say, the execution risk. We are seeing a lot of liquidity issues in the current marketplace as we are heading towards the year end. That's one thing. There's a lot of concern with fund redemptions coming from the investment side. There are also concerns about where the interest rates may be moving going forward. I would say there are also some unwarranted claims that some parties are thinking that rates might go higher as the U.S. Federal Reserve hike interest rate this coming December. So my role here is pretty much to keep the circle between these two segments. I mean, as long as the cycle continues to be working in normal situation, then I will have a role to play in the market. If there's any signs or any signals of clogging, then it will make my life much more difficult. Right, on the investor side, I mean, you'll see the typical investors will be the fund managers, insurance companies, banks. Banks will normally buy a Sukuk for their investment books. This will be parked under the banking, available for sale banking books. They are also for help for maturity and also trading. We saw the growing growth of private banking industry over the past 3 to 5 years, thanks to the low interest rate environment whereby clients are getting more sophisticated these days, and as they seek or chase yield, we've seen a growth in this segment. Retirement funds, as you know, our big two, big three funds, they are always there in the market to invest into our asset class. Takaful companies, I mean, we also seen a big growth from the Takaful players into investing Sukuk. Corporates, normally for liquidity purposes, as and when they have excess cash for their liquidity, they may park into Sukuk for their short-term, normally anything that offers higher returns as compared to the normal fixed deposits. Foreign investors, and lastly is foreign investors. I think early this year we saw Barclays Global Bond Index included one of our Malaysian government investment issues, which is Sharia compliant government bonds or government sukuk into their index. So we have seen a big demand for our GI for investors that measured their performance against the index. In terms of issuers on the left side of the circle, I mean, we have seen the normal players issuing or tapping the sukuk space over the years. Government has always been the largest recipient for tapping. We've seen, I mean, the evidence of this. We've seen the likes of MRT, I mean, issuing Dana Infra Sukuk for their MRT Line 1. They may come up with a new Line 2 Dana Infra Sukuk issuance sometime next year as they complete their first project on the Line 1. Corporates, normally we have seen various corporates coming from various sectors such as plantation, holding companies, banks, and also shipping, oil and gas companies over the years to tap the sukuk space. Banks is always the normal player in this space, given that bank needs to borrow to fund their requirement, especially their liquidity requirement. Non-bank FIs will be the likes of Takaful and insurance players, and also building society like Malaysia Building Society, MBSB, and also foreign issuers. We've seen in the past a growing non-Malaysia domicile corporates issuing in the ringgit space. We've seen the likes of Saudi Arabia corporates came to the market, Turkish bank came to the market, the likes of supranational like Islamic Development Bank tapping the ringgit space. Right. Second slide is pretty much to summarize where we are in terms of the Malaysian bond and sukuk market. As you know, Malaysia has the largest bond and sukuk market, largest local bond market in the ASEAN. I think we are easily second or third in the Asia space. In terms of sukuk, we're still leading in terms of market share. But as you can see from these slides, you'll find there are also some lagging countries in this region which offers a lot of growth potential to tap the regional bonds or sukuk market. I mean, the likes of Indonesia only has about 14% of their issuance out of 50% of the GDP in the bond space. And the likes of, say, Thailand, I mean, they are still way behind compared to Malaysia in terms of that market. I mean, 97% of GDP for Malaysia is quite remarkable. I mean, you're talking from an economy, you're talking about a market capitalization of 1.3 to 1.4 trillion ringgit in terms of size, and it's kudos to our regulators and also the market players in developing in the local bond and sukuk market. So the idea is to continue to develop this market. I think I would like to use the quote given by the first speaker just now when it comes to developing the sukuk space. I mean, view it as a barakah. Take it as we invest or as we develop this market further. We also inshallah, we'll earn some good deeds for developing the markets. Right. In terms of risk, I think most of the risks have been covered by the first and second speaker just now. I think the second speakers have highlighted all the segments of risk involved. The idea is to embrace risk, since we cannot run away from risk. In all economic activities, there's always a risk involved. We need to be embracing risk and manage and address risk accordingly. Like the second speaker mentioned just now, with no rezeki, there's no rezeki without risk. So we are here to be the risk hunters. I'll talk more on the risk that I'll be talking about is coming more coming from the market risk. This will be the likes of interest rate risk, the one that I mentioned earlier, liquidity risk, credit risk when it comes to Sukuk, and also the FX risk, which is the price risk. Next slide is pretty much the definitions of the risks involved. I'm not going to go through the line by line of the risk, but it's pretty much, I'm sure most of you guys are very familiar with the risk involved, as stated earlier in the previous presentation. When it comes to, I think I would like to talk more about the liquidity risk. I guess that's where most of the issues has been propped up in the current marketplace. A lot of issuers are tapping the Sukuk space currently in the third and the fourth quarter. There was a lot of anxiety, a lot of panic from the issuers to tap, given they perceive rates may go much higher next year. Right. One of the drivers for this liquidity risk is, I would say, due to the diverging monetary policies that we've seen across the globe. We've seen the likes of U.S. Federal Reserve, the U.S. central banks, hinting about hiking the rates sometime next month, in December. That has somewhat bring back the volatility to the market. I mean, some of these Federal Reserve governors kept also giving different tone or language among themselves. That's also created a further volatility to the market, given everyone have their own opinions where rates should be going forward. In terms of tightening, we are seeing US may lead the way in terms of the tightening phase, but at the same time, we've seen the likes of Eurozone and Japan continue their QE policies. China have cut People's Bank of China have cut their local rates for 3 times this year, and the recent CPI data may suggest that there will be more easing going forward. In ASEAN especially, we've seen the likes of our neighboring countries continue to ease, the likes of Thailand and also South Korea continuing with their cutting and accommodative policy. Some of other emerging markets, countries such as Turkey may embark into a different policy which to tighten, given Turkey, the likes of Turkey, Brazil, and South Africa, for example, have seen a lot of fund outflows for the past 9 to 12 months. Second slide is pretty much to summarize some of the outflows that we've seen. The more constructive graph will be the first graph. That's basically the interval monthly fund outflows. We've seen a strong outflows back in July 2015. And the second slide below is pretty much a summary of the interval weekly fund outflows. I'll say the first graph depicts a better signal, where the funds has been going out. I mean, as you know, when US started the QE back in end of 2010, early 2011, emerging market space has been the biggest benefactor for these hot money, easy money, cheap money from the central banks. So we are seeing these funds coming out, going back to their home countries as US tighten their local rates. Our local markets are also not spared for this. I mean, given the timing where we are now, a month from the Federal Reserve meetings, I mean, we've seen the likes of our local government and GRI volumes dwindle since August this year, whereas our corporate bond secondary has always been quite stable. It's been more of a buy and hold kind of market, whereas I think given that fact that the GRI, one of the GRI has also been included inside the Barclays Global Bond Index. That's why we've also seen a decrease in volumes as we head towards the year end. In short, when it comes to managing liquidity risks, the challenges and outlook, I would suggest, I mean, as funds or banks who manage investment books, to manage these liquidity risks by analyzing the wide bid offer spread in terms of spread and also prices. My best advice would be normally to, with bigger issue size, that will be better liquidity for you to in and out in the market. The next advice will always be to monitor the rotational play between developed markets and emerging markets. That's what's been going on over the past few months, where funds are going back to developed markets, particularly US. It can be in the US equities or even in US bonds, depending on your interest rate expectations. And we've seen funds going out from the high yield emerging market space into investment grade. I mean, some of the funds who have the dedicated investment mandates to invest into emerging market, they may move up from the high yield sector and move higher to up the credit curve to investment grade rated instruments. For trading, coming from a bank angle, you may want to analyze the repo agreement for the Sukuk. Normally, traders, in order to make markets, they need to understand whether some of these instruments are available for repo so that they won't be short in the market. Some of the points are to analyze the inherent technicals. I mean, the technicals over the years has been driven by QE. This is pretty much the demand and supply. We've seen a strong demand for Sukuk, especially for global Sukuk, i.e. non-ringgit or dollar-denominated G3 Sukuk space have been driven of demand given the lack of supply or not enough supply in a space. Analyzing the bid-to-cover ratio on recent primary issuance may also some idea how's the take-up rate for all the primary issuance. Where I'm coming from in RHB, we'll comb the market in terms of appetite, in terms of stock orders for any new issuance, in terms of pricing. Sometimes we may even have to come up with a market clearing levels for this new issuance so that we don't suffer any execution risk. This challenging market will continue to take place until we see some clarity from the global central banks' monetary policies. Coming from the bank side, there are also challenges when it comes to the new liquidity framework for Islamic banks and takaful companies. There are challenges when it comes to how Islamic banks or Islamic players address the suggestions or recommendation by the Basel III. There are some issues with regards to how the treatment for non-conventional Islamic structures such as Mudarabah and Musyarakah, which may affect the liquidity, the pricings, given the different returns payoff of these structures. So, like for example, Islamic banks, if they were to invest into these two types of structures, they may adhere higher capital charge for their books. But then again, this will be compensated with the higher returns for investing into these papers. The next risk that I would like to highlight is the interest rate risk. As mentioned earlier about the concern about the tightening from the US Federal Reserve, there's also these unwarranted claims or unwarranted views from the local market participants about higher interest rates going forward. You'll see from the graph, the movement of 3 months CLIBOR rates with regards to secondary corporate bonds or Sukuk volume. As rates changes, you will see the volume will decline. In relation to the price of Sukuk's inverse relationship with the rates. I think the best question right now is, since most of the participants are expecting a rate hike or higher rates going forward, the questions that should be addressed by everyone involved is to gauge how much, if there is any rate rise going forward. I think we've seen this concern early in 2014 and even early 2015. There's always been a lot of fear when it comes to New Year, and a lot of when it comes to New Year that investors may want to stay sidelined until they see better clarity in terms of where the rates are going. Normally after Q1, you'll see once they have this certainty or clarity about where rates are going, they will come back to invest into the markets, and this is can be proven from the annual returns coming from bond or Sukuk fund over the past 2 years. From a local domestic front, I think interest rate risk, I think RHB Research Institutes, we have a view on our inflation level. We felt the inflation level may be moderated a bit since September, despite the reduction in some of the subsidies. And we may only see a mild trend of upwards for the inflation, which is, this will be able to address the issues with how much rates to hike or to go higher much later next year. In terms of OPR, which is the Bank Negara's monetary policy tools, we opine that the OPR level will remain stable for the rest of 2015 and 2016. With that, there's locally, we don't see much risk coming from these local drivers to push rates higher, but then again, other factors such as the fund outflows, FX risk, our dollar ringgit levels in relative to US dollars may play some behind the scene drivers for our local domestic rates. Next slide is pretty much a depiction of where some of these US Fed members' expectations on the Fed fund rates over the next 2 years. Please bear in mind that this is just a guidance from the Fed members to educate or to the market participants. I think in the past they had a shock when one of the former US Federal Reserve Chairman, Mr. Alan Greenspan, hiked 300 basis points overnight. I think under the new chairmanship of Janet Yellen, she's trying to manage the expectations of the investors so that we won't see any abrupt disruptions to the market. As I mentioned earlier in my first slide, any disruption to the liquidity cycle between the buy side and the sell side will cause a lot of risks to all the participants involved. Next slide basically is a summary of where the next policy meetings will take place in this month and next month. I guess the most important date will be the 16th December 2015, whether the US Central Bank will decide on their policy rates. To summarize, in terms of interest rate risk, I would recommend to select some duration play for investment portfolios. This will be related to where one sees their interest rate expectations. Some may want to reduce the duration of their portfolios if they expect the rates to go higher. Some may want to be stationed or position themselves at the long end, given there's not much inflationary threat going forward, whereas there's a lot of volatility in the short end space. Other hedging instruments that are available for players are the Islamic profit rate swaps. We've seen growing numbers of players coming from the banks to hedge their investment books when it comes to interest rate risk. And recently, the Bank Negara and also financial market associations, or in other name PPKM, we've suggested to the market players to start to engage into documentation, for example, ISDA or IDMA, if they were to start hedging their portfolios with Islamic profit rate swaps. The third risk that I would like to highlight is the FX risk. This is when it comes to, depending on how you manage your investment portfolios, if your home-based currency is dollar, investing into ringgit Sukuk or ringgit assets, you'll be exposed to FX risk as ringgit weakness, depending on your entry level when it comes to buying into these emerging market currencies. From this graph, you'll see some of the risks, global and domestic headlines that have hit our onshore for the past 1 year. We've seen oil price decline or drop more than 50% since July last year. We've had some political noise ever since early this year with regards to some of the companies operating locally. And also in terms of global or regional headline risk, we saw the likes of China devaluing their currency. This has created pretty much been driving our local effects, our local exchange rates. Next slide is basically to depict where the dollar index, which is relative to other currencies. I mean, as you see, the dollar index, as US tighten, as some of these funds outflows back to their home market, back to US, which is the borrowing currencies, you expect to see this dollar index to strengthen further. In terms of managing FX risk, I mean, there are some instruments in the market, namely like Islamic FX forwards, using the principle of wa'ad or commodity murabaha that offers investors to hedge their currency. Participants can also engage into Islamic cross-currency swaps, ICCS, in managing both the interest rate and also the FX risk. I think in terms of challenges, we still have some issues with regards to standardizing the documents across various jurisdictions. Banks or players out of Malaysia, we have a separate set of documents, whereas other players from Middle East or, say, for example, Brunei, they have their standard different types of documentation before we embark into the hedging of these instruments. Besides that, the Islamic Collateral Support Annex, the CSA, has not been fully developed and adopted by market participants. There still needs some clarity when it comes to collateral. This will be applicable for both investor side and also the issuer side. The fourth risk is basically the credit risk or the default risk. The table here basically shows that the sovereign CDS over the past 5 years may have bottomed in 2014. We have seen some increasing in terms of CDS level for some of the emerging market countries. We've seen recently the downgrade of Saudi Arabia, Kingdom of Saudi Arabia, from AA- to A+. That has, from this graph, you'll see the Saudi Arabia's CDS level, which is the blue line on the bottom, have started to creep up after the announcement of the rating profile of Saudi Kingdom. So I guess as a players, I mean, even though there's no Islamic, there's no Sharia compliant CDS for players to hedge, but then again, you may want to use some of the CDS level as a proxy as you serialize your investment portfolios. Next slide, I got this graph from EPFR, one of the publications that shows that actively monitors the fund outflows between developed markets and emerging markets. As mentioned earlier, the emerging market has been the largest benefactors from the cheap money over the years. So we've seen the likes of fund outflows registered into this graph. Basically, during these asset allocation changes of the asset allocation by the fund managers, monies are going out from the EM bonds and also EM equities and going back to developed markets equities and bonds. The fourth graph on the bottom right shows the continued decline in EM local bonds and also EM blended assets. Locally, in terms of credit risk, the average credit spread has remained stable over the past 1 year. You'll see the likes of single A rated, for example, a 5-year single A rated spreads are still manageable between 300 to 250 basis point over the prevailing benchmark government bonds. This has been quite stable. I mean, we've not seen major correction. We may see some recently, but that's purely due to liquidity purposes, not really on the upgrade or downgrade issues. The graph below is a summary of the upgrade and downgrade ratios from the 3 major rating agencies, Moody's, S&P, and Fitch, and also our local rating agencies, the likes of Rating Agency Malaysia and MARC. You'll see from this graph that the upgrade and downgrade ratio has somewhat declined over the past since this is a table since 2012. So, like for example, the upgrade downgrade ratio has gone down. I mean, this is a concern, meaning there are less upgrade cases as compared to downgrade cases in 2015. So this may shows a higher chance of downgrade ratio going forward. Even though in terms of spreads, he hasn't shown the widening credit spreads, but in terms of from the rating agency's angle, this graph or this table is showing you a different picture. So investors may want to take this view and be more wary when it comes to approaching. You may also want to demand higher credit risk, credit premium in terms of a new issue premium for any new issuance going forward. To summarize, in terms of credit risk, I would say if you're to manage their portfolios actively, I mean, continue engagement with issuers, continued engagement with rating agencies, and analyzing the issuers' repayment capabilities, collateral assets. This will be one of the normal proactive approach for the players. Players may also, currently there's no Islamic hedging instruments such as CDS, Islamic CDS to hedge their credit risk. So normally at this current juncture, you'll be sitting ducks if there's any downgrade or risk changes in the ratings profile of the issuers. As I just mentioned earlier, you may want to monitor some of the synthetic CDS level on the conventional basis to monitor the movement. As in terms of challenges and outlook, we will expect to see more market players to quote corporate bond or Sukuk based on credit spreads over their prevailing MGS and GI instruments. Hopefully, by embarking into quoting these Sukuk with a defined corporate spreads, this will lead us to embark into a Islamic single issuer CDS in the future, if any. I'm not going to touch base on the validity of some of these hedging instruments. I will let the Islamic scholars to debate among themselves about this validity, whether is it Islamic or non-Islamic. There are also some suggestions from the market participants to have or to form Islamic credit hedging agencies. We saw the likes of Dana Jamin, which is 50% owned by CGC and Bank Negara, in providing the financial insurance guarantee. The idea is like if we have such agencies, then banks will be able to hedge their exposures into these instruments and free up the capital to further lend to other sectors, for example, the SME sectors in the market. With that, I conclude my presentations.